Hello, good morning to all. Welcome to today's Daily Dose of Market Insights. I'm Kelvin Wong, the Senior Market Analyst of OANDA Asia Pacific. Happy Friday and good morning. Today will be the 10th of November. So before we start our Daily Dose of Market Insights, let's take a look at the disclaimer slides first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product, as well as any forecast, prediction, or projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. All right, so as usual, this will be our three key, we call it gist, or I will say the agenda for our usual daily dose of market insights. Firstly, we will cover what happened overnight during the European session, as well as most important, the US session, and is there any we call respective key events or data that actually shook the market or actually caused a higher volatility movement on the broad-based asset classes? And we will actually start also secondly, we will cover what are the events that has taken shape earlier during the Asia session today, that means before 11 a.m. and as well as what are the remaining key events and data to look out for today, which is Friday. And most important, we will be sharing the short-term technical outlook on the broad-based asset classes, ranging from the we call it the major benchmark stock indices across the globe, followed by the major FX pair, and as well as the two commodities key markets, which is primarily on gold and oil. Okay, so without further ado, let's kickstart. Okay, what happened yesterday? Yesterday, primary event was actually Fed speak. We have a slew of Fed speak that occurred during the US session yesterday. So what's most important over here was the speech by Federal Reserve Fed Chair Powell. So if you look at the speech by Fed Chair Powell yesterday, it was pretty clear that what did he mention, that he was still rather reluctant to actually be dovish and to tilt the expectation towards we call it that the Fed officials or the FOMC as per se, they are actually right now discussing the first interest rate cut to come as soon as Q1 next year. So he downplayed that particular expectation. And what's important over here is that he said the Fed got to be careful, the word, and won't hesitate to hike if needed. All right. So it's still being what I call peppered with what I call a mild hawkish vibe for Fed Chair Powell. So market actually I would say market participants actually translate to his thinking that, hey, right now very likely that the financial condition has started to loosen again a slight bit after last week. Markets we call it overshoot that the Fed is turning more dovish, and that actually drive up risk asset. That means we talk about long duration risk asset like long-term bonds, and most importantly, the high growth equities like the tech stocks and as well as the growth stocks. Okay, they actually rallied very strongly last week, especially the Nasdaq 100, where last week weekly gain was actually the highest throughout this year. So Fed Chair actually toned down the expectation, and what you see over here is that the CME Fed Watch 2, that means this actually implying market expecting market expectation on the probability of the rate cut or rate hike in the future FOMC meeting, as implied by the Fed funds interest rate futures. So for the month of December, right, I want to highlight to you for December, it's still no change. It's still roughly a very low number at 9.3%. All right, almost the same as before Fed Chair Powell speech yesterday. To maintain it, that means there's only a 9% chance of another 25 basis point hike to 5.5% to 5.75%. So I'd like to actually give you guys a reminder that 5.5% and 5.75% is the potential terminal rate of this current hike cycle based on their previous dot plot that was released earlier in the earlier meeting in September. So, but if you look at the January meeting, the 31st January 2024 meeting, the chance of the 25 basis point hike to that what I call expected terminal rate of 5.5% to 5.75%, pardon me, has risen quite a fair bit. to 19% yesterday. That means a 3 basis point increase after Fed Chair speech. But what's interesting over here is that the first interest rate cut, right? Initially at the start, at late last week, it was actually penciled in, being brought forward to a high chance of close about 50% to as early as May 2024. So if you look at the accumulated probability right now, after that mild hawkish vibe that being being what I call that dictated by Fed Chair Powell's speech yesterday, the May meeting next year, 1st of May meeting next year, this American date. So the first month, the first figure you see will be the May, will be the month instead of the date. So 1st of May 2024, the chance earlier on was about 50%. It dropped to 36.8%. So what we could see over here is that we do reckon that Federal Reserve officials are actually watching the expectation of this, we call it futures pricing as well, because from what Fed Chair Powell's speech over here is that they do not want markets start to be jumping ahead or fighting against their mandate, that they are still at the moment in time still cautious on a revival of we call it elevated inflationary expectations seeping back into the US economy. So every time when expectations start to increase for the Federal Reserve officials to bring forward the first interest rate cut, it seems to us that Fed Chair Powell will start to come out to have this kind of hawkish vibe statement to push back the first interest rate cut expectation. So the first interest cut expectation now has been still been penciled in somewhere around in June and July. So this has been pretty much no change since the last 2.5 months, with a probability ranging about 60% to 70%. So it's still quite high. So very interesting to see if the June the June expectation starts to dip below 50%, especially when we come earlier to the next FOMC meeting on December, which is 30th of December. This is where they will release their latest dot plot figure that project future interest rate trajectory, as well as inflation forecast and real GDP forecast, to see whether does it starts to be rather hawkish, that tone down the first interest rate cut to come in June and July this year based on market expectation pricing via the interest rate futures, all right, from the CME Fed Watch 2. So now impact on the market, very important, is that US 10-year Treasury yield. So if you look at the US 10-year Treasury yield over here, okay, let me hide over here. Okay, so that US 10-year Treasury yield, right, managed to bounce off from a key support level at 4.5%. So what is 4.5%? Is the lower boundary of this medium-term ascending channel that is in place since May this year. And after that, it actually going to evolve in this channel much more prevalently after that bullish breakout in July. All right, what we could see over here. So all in all, what you could see is that if this channel trajectory holds, in the next couple of months, potentially it could actually hit higher to the 5.2% resistance. We're so confident with this current medium-term ascending channel upper limit. Okay, so all in all, right, then what we see that RSI is also pretty much positive, bouncing off the parallel support level, linking the lows of 30th of November last year, 6th of April this year, and most recently yesterday's bounce as well. So, and reintegrate back into the 50-day moving average. So for sure, the bullish acceleration on the upside should potentially come if the price action of the 10-year Treasury yield managed to break above the 20-day moving average, now acting as an intermediate resistance at around 4.77 level, okay, which is this level here. Right. So all in all, for sure, definitely, because if you look at the last few 2 months, or I would say 2.5 months of price movement since July, a further rise in interest in this US 10-year Treasury yield moved in a very indirect lockstep correlation with equity prices, especially US equity prices. Higher rise in yield, US longer dated yield, which is the 10-year US Treasury that I show you over here, put more pressure on a higher cost of funding. Eventually, long duration risk assets like technology stock or growth stock will hit the hardest, especially growth stocks that do not have a profitability and depending on we call it a leverage to actually sustain their operation. So this primarily being focused on the small cap stocks. So that should explain why the Russell 2000 has been underperforming this week. Yesterday going to underperform at negative 1.57%. and even now the Nasdaq got hit as well, negative 0.82%. Reversing earlier part of this week gains. So earlier part of this week gain is being driven by Microsoft hitting all-time high. Why do they hit all-time high? Because due to that AI optimism again back into the market, because on Monday, OpenAI, which Microsoft is a majority shareholder, announced developing new AI tools in their ChatGPT product suite. So that actually drives up the gain and also drives up NVIDIA gain as well. But yesterday, due to the fact that this optimism has started to face reality again after Fed Chair Powell rather hawkish vibe statement. So eventually the S&P got hit as well, negative 0.8%. The Dow Jones Industrial Average, where we have been pretty much bearish across this week, if those who follow our daily dose of market insights, we've been pretty bearish because it's been trading in a sideways configuration, and yesterday continued to react off that short-term pivotal resistance that we highlighted in our short-term technical outlook since start of Monday. So if you look at the heat map of the S&P 500, so for sure, what we could see a sea of red in the mega cap stock yesterday. All right, over here as well, mega cap stocks, where we see Microsoft retracing this week gains, followed by Apple, Amazon, Tesla, Google. NVIDIA still hovering around that positive mark at positive 0.81%. But what's interesting over here is that the banks itself is rather lackluster. JP Morgan, Bank of America, Wells Fargo. So all in all, right, what we could see over here is a rather weak, we call it performance, being spilling over towards the entire sector, almost the entire sector of the S&P 500, which i.e. Put into question of last week's strong rebound. All right, so now with that, what are the things that has already been announced today's morning? I want to highlight over here is due to the fact that RBA today released their statement. So it's actually a monetary policy statement over here. Where is it? Yeah, RBA statement. So it's in this Tuesday just concluded statement. But I want to bring a highlight to you all is their forecast. So the statement, right, they will accompany their key economic forecast. So the economic forecast, I want to focus on the CPI. So do you still recall that RBA to this Tuesday actually restart their interest rate hike cycle by hiking another 25 basis point after they paused for 4 consecutive meetings previously. So what's interesting over here that you look at the minds of the RBA officials, especially right now RBA is being headed by a new governor. Okay, so the forecast over here, I want to focus the trim mean inflation. What's trim mean inflation is they exclude the outliers. So for the month end of December, that means towards December, that means end of this year, 4.5%. The normal CPI 4.5%. So this was the November one, means the latest forecast. If you contrast it with the previous forecast in September, which they did, all right, it's August, the last August forecast. So last August forecast was much lower at 3.9% and 4.1%. And if you look at the end of 2024, trim mean 3.3%, CPI 3.5%. Okay, trim means lower 3.1%, and the CPI is 3.3% only. So all in all, what you could see over here, right, is that the expectation of inflation is going to be much more being elevated right now in Aussie land, that means Australia. So that could actually, right, means that what we see now, RBA right now is very unlikely to turn dovish again in the next couple of minutes. That means either there has 2 chances of maintaining interest rate at this elevated level. That means the chances of them to cut interest rate next year, I would say in at least in Q2 next year, is very, very low. All right, so it's either they maintain it at this higher elevated level, or they could actually potentially start to do another round of interest rate hike instead. So that actually primarily should be pretty much positive on the Aussie dollar. So if we call that Aussie dollar in the first half of this week, we bearish. Why? Because there was a bit of optimism that is being priced into the Australia dollar, means Aussie USD. But on Wednesday, the price action has really retraced down to our downside mean reversion target or support level, where yesterday we flipped to a bullish bias again. And what's interesting over here, right after today's statement, this rather hawkish forecast in Aussie land on their interest, on their inflation expectation, future inflation expectation and forecast by RBA, managed to stall yesterday Aussie dollar decline against the US dollar at the key short-term support level. So later I'll share with you in the short-term technical outlook. All right. Now, very quickly, what are the key events to look out for today? Is GDP growth rate up from UK, preliminary Q3 at 3 p.m. Singapore time today. Market is expecting year-on-year growth to actually come down slightly lower, 0.5% versus 0.6% in Q2. The quarter-on-quarter one will be in negative 0.1% versus 0.2%. So it's rather lackluster forecast. So that could actually potentially put downside pressure on the sterling dollar if the forecast came below this lackluster forecast as being penciled in by the consensus. Then going forward, throughout the US session over here, there will be a speech by ECB President Lagarde speech at 8:30 p.m. Singapore time, then followed by an all-important consumer sentiment preliminary flash forecast for the month of November. So this in the last 4 months or so, I would say that consumer sentiment has been pretty much declining in US. So if you look at the trend of the consumer sentiment, 1, 2, 3. So if the flash forecast come in at 63.7 later, it will be 4 consecutive months of lackluster consumer sentiment in US. So kind of indicating to us that the demand side of the story is getting weaker in US. But however, it seems to me that the Federal Reserve officials are not buying into such weakness. They are still pretty much concerned about higher elevated inflation coming from the supply side of the story. All right. Okay, so that will be the key data to look out for, which I explained in pretty much we call it informative detail. So now let's jump into the short-term technical outlook instead. So now let me hide myself so that you all could actually focus more on the screen, right? So now let's start with the FX market first. So on the FX market, right, we know that for sure the dollar actually strengthened yesterday. So let's start with the Aussie dollar, since that's how I mentioned the Aussie dollar. So on the Aussie dollar, right, what we could see is that yesterday's price decline and right now managed to stall at around 6.333 level, which is the pullback of this former ascending wedge bullish breakout now turns into the pullback with support level, and so confluence with the low of 31st of October and 1st of November, okay, at this point in time. So if you look at the hourly chart from here, okay, so we will still maintain that bullish bias at around 6.345 level, this range level here. So with 6.345 level as my key short-term pivotal support level, RSI back at the oversold region, but we have an upside trigger level, which is the 50-day moving average that was taken down yesterday after Fed Chair Powell's speech. So 64 figure level will be the upside trigger level to reinforce this recovery towards 65.20, which is the high of this Monday. Okay, so all in all, maybe perhaps I will have in the shorter term, right, during the intraday, I will add another intermediate level over here, okay, which is the swing high of this Wednesday at 64.43. So a bullish breakout is required for it to go up towards 64 figure level, then followed by 64.40, then thereafter 65.20. However, if we start to see a bearish breakdown below 63.45, that means an hourly close below this level, then we will start to see a choppy movement heading down towards 63.20 and the key medium-term support level at 62.70 on the Aussie dollar. Okay, so now dollar yen. So dollar yen, we will be pretty much bullish since the mid of this week on Tuesday after it broke above the 150.60 level or 150.50 level. So it's going to churn upwards, heading towards the major resistance at 51.95. So all in all, right, we'll be having a very tightened key short-term support for level for this week at 50.70. So 150.70 will be my key short-term pivotal support to maintain that short-term bullish push up towards the key resistance level at 151.95. Okay, key major resistance level. So however, if we start to see a bearish breakdown below 150.70, then potentially we could start to see a further slide down towards 149.85 on the dollar yen to test the 20-day moving average again. All right, so that's for the dollar yen, still maintaining that short-term bullish outlook, holding above 150.70 key short-term pivotal support for today. Now, the European currency, so heading towards the sterling dollar first. So sterling dollar, right, yesterday it actually kind of broke below the 50-day MA, and right now start to show what I call exhibiting a kind of very short-term bearish element start to show on the the sterling dollar. So what we could see over here is it could actually imply, right, for a very kind of a very short-term messy choppy downward movement to test this region over here, the 121.90 20-day moving average, followed by 12155 slash 12120. So what's 12120? 12120 is in fact the pullback support level of this former descending channel resistance now turns into a pullback support over here, as seen on the daily chart. Okay, so overall, right, is more I will actually flip to a short-term bearish bias in short-term only, heading towards this level over here. If 121.90 breaks down, accelerating towards 12155 slash 12120, this will be like a key medium-term support level, as long as 123 figure level, key short-term pivotal resistance holds right today. But however, if we have an hourly close above 123 figure short-term pivotal resistance, then this short-term bearish bias outlook will be invalidated to see the sterling dollar squeezing up to retest the 200-day moving average, acting as also confluencing at a resistance at 12440. Okay, euro dollar. So on the euro dollar over here is for today I'll be having a much more neutral range. So yesterday it managed to help above the key short-term pivotal support at around 160 70 level. So I'll be using yesterday's low, which confluence with Wednesday's swing low, which is at 1.0660. So neutral between 1.0660 and yesterday's high before Fed Chair Powell speech at 1.0725. Okay, which is also confluence with this minor congestion area here as well. So neutral between 1.0725 and 1.0660 for the euro dollar for today. If we start to see a breakdown at hourly close below 1.0660, then we could see a very similar movement like the sterling dollar, a choppy downward movement to test the medium-term support level at 1.0570 slash 1.0520 level. Okay, so neutral for the euro dollar for today. Okay, now that's much coverage on the FX space. So now let's head towards the indices. So over at the indices over here, let's start with the Asia market first. So over the Asia market, this Hong Kong 33 yesterday shaped a bearish breakdown again below the 20-day moving average. So yesterday we used around the 17,470 level as a key short-term pivotal support to look for the recovery. So that the recovery didn't take shape, and price action now very likely is able to test the medium-term support level at 16,980 slash 800, which is this level over here that confluence with the swing low of 24th of October, and as well as if you go to the daily chart, 16,800 is in fact this region over here. Okay, this medium-term congestion area of 7th of November last year and 28th of November last year. Okay, so all in all, right, we will start to see a bit of a short-term bearish bias creeping back into the Hong Kong 33 index, as long as 17,470 key short-term pivotal resistance holds, not breaking below this level. So we potentially could see a further downside to test this key medium-term support range zone at 16,980 slash 800. However, if we start to see an hourly close above 17,470 later, then this short-term bearish bias will be negated to see a squeeze up to retest the 50-day moving average, acting as a next intermediate resistance, confluencing at 17,780. Okay, so that's for the Hong Kong 33. German 30. So German 30 yesterday we turned neutral because price is actually heading very close to the upper limit of this descending channel that is in place since 31st of July. And price squeeze up that level before actually reacting right exactly at that level and close below the 50-day moving average again, reintegrate back again. And what you see over here is that the push up in price action is start to shape higher high, but the RSI now start to shape lower high at the overbought region. So indicating to us that yesterday push up does not have that desired momentum to follow through. That means instead momentum has started to turn negative by the flashing of this bearish divergence at the off-board region, as depicted by the hourly RSI. So we'll be flipping now back to a bearish bias again. 15,410 key short-term pivotal resistance for today, looking for the push down at least to retest 15,090. So that is actually this week low, which is Tuesday low and Wednesday swing low. So flipping to a bearish bias on the German 30 index. But however, if you have an hourly close above 15,410, then this bearish bias will be invalidated to see a squeeze up towards the next resistance at 15,570 / 15,680, which is the 200-day moving average, and as well as 15,570 is in fact this minor congestion area over here, and as well as the 50% Fibo retracement of this ongoing medium-term decline that is in place since end of July. Okay, so that is the outlook for the German 30 index. US indexes. So US indices, for sure, the Wall Street 30, we will remain bearish. So yesterday it hit our first support level, which is the 50-day and the 200-day moving average, 33,885. So I don't want to tie it so tight to yesterday's US session high. Still remaining at, so yesterday US session high was this level. So this is more like an intermediate level over here. I don't want to tie it so tight to this level, 34,110. So I'll be still using 34,300 as my key short-term pivotal resistance. Why this level is key? Because it's also confluence with the descending channel, the descending channel upper limit that is in place since 1st of August. So all in all, still maintaining that short-term bearish bias on the Wall Street 30 index, which is the Dow Jones Industrial Average. A break today, an hourly break below 33,885 will further reinforce that short-term bearish outlook, heading towards the next support level at 32,560 / 32,390, which confluence with the 20-day moving average, I think as a support level as well. So then also the RSI hasn't hit the oversold level yet, and also didn't flash out that bearish divergence, a bullish divergence, I would say, because price action continue to trade. Price action on the RSI going to trade a lower low in line with the price action of the price, in line with the price action. Yeah, I would say. Okay, now Nasdaq 100. So for the Nasdaq 100, right, we'll be pretty cautious right now. Why? Because price action yesterday we do have a bullish bias holding above 15,160. So what's 15,160 is actually the pullback support of this former medium-term descending trendline resistance that has been taken out on this Monday and Tuesday due to the AI optimism coming from Microsoft and Nvidia. So all in all, right, yesterday we do have a kind of a failure minor bullish breakout, fail to break above Wednesday swing high. If you have to break above, then thereafter it plummeted down. So given the fact that we start out to see the US 10-year Treasury yield on an uptick, and bear in mind that, like I said earlier in my today's daily dose of market insight, US 10-year Treasury yield is rather very sensitive to the price action of long duration risk asset equity, especially on the Nasdaq 100, given that they are technology and growth driven. They actually have an inverse reaction. That means, i.e., if US Treasury yield going to tick up higher, it could actually face further downside pressure on the Nasdaq 100. So with that, I will flip to a neutral stance for today, rather than be maintaining that bullish bias, even though it hold above the 15,160 key short-term pivotal resist support level I highlighted yesterday. So for today, our neutral between these two range, 15,350 and 15,160. Only a hourly close above 15,350, then we would validate that short-term bullish outlook heading towards the next resistance level at 15,540 on the Nasdaq 100, which is the minor range top of 4th of September and 15th of September. So rather be cautious for today. But however, if you have an hourly close below 15,160, then the Nasdaq 100 will be in sync with the other major US indices to actually undergo this short-term bearish outlook, heading towards the next support level at 14,875 / 14,780, which is also confluence with the 20-day moving average, I think, as a support in the short term. All right, now moving on will be the gold. So for spot gold, right, spot gold, we will maintain that short-term bearish outlook with a tightened key short-term pivotal resistance, still maintaining at 1972, looking for a push down towards 1932 / 1920, which is the 20-day and the 50-day moving average acting as a support level as well. However, if we start to see a squeeze up above the 1972 level, so now also confluence with the 20-day moving average acting as a resistance, then this short-term bearish outlook will be invalidated, and potentially we could start to see the start of another impulsive up move to at least retest 2006 level in the short term, followed by 2028/2036 resistance level on gold. So still maintaining the short-term bearish outlook on gold for it to actually continue to end this potential retracement at 1932/1920. Okay, so now what's the outlook for oil? So very quickly, let's open up the chart of oil. Okay, so for oil, over here, if you look at yesterday, we do have a bearish bias for oil. So for oil, right, it's going to churn sideways yesterday above that key access short-term pivotal support level at 75.60. The RSI continued to slope upwards. All right, you see over here. So all in all, right, we will still be using this 75.60 as my key short-term pivotal support level. Still looking for that potential counter trend rebound in short term to take place in oil, but provided that it got to break above this upside trigger level, which is at this 78.10, which is confluence with the 200-day moving average as well. So if we start to see an hourly close above 78.10, then potentially we have a higher odds of that minor counter trend rebound at least to take shape heading towards 85.05, which is the minor swing low, former minor swing low of 2nd of November and 4th of November, that confluence with this minor descending channel resistance that is in place since 20th of October. But however, if we start to say hourly close below 75.60, then this bearish impulsive down move should continue heading towards the next support level at 73.80. All right, so guys, so that is the key highlights on the highlight for today's daily dose of market insights. So we've come to the 33-minute mark, just nice. So with that, do have a great weekend ahead and happy Friday. And I will be on leave for the entire of next week. All right, so entire of next week I'll be on leave. So I shall speak with you all again on the 20th of November. All right, so with that, have a great weekend ahead. Thank you.